Welcome back to Talk Tickers. This is the deep dive. We're stripping away the corporate fluff today.
And ignoring the PR spin.
Exactly. We are getting straight to the numbers, the narrative, and the tape. It is Tuesday, February 24th, 2026. I am your host, and today, we have a body on the table. We are dissecting SolarEdge, ticker symbol SEDG.
It really, it feels a bit like a crime scene investigation today, doesn't it?
It really does.
Yeah.
Look, if you have been riding the solar coaster, I kind of hate that term, but it fits for the last 2 years, the trauma.
Oh, yeah. 2024 was an absolute disaster.
Right. And 2025 was what management explicitly called a survival year. And now here we are in early 2026, and management is coming out swinging.
They are claiming 2026 is the pivot to offense.
But looking at the tape, I don't think the market believes them.
The market definitely blinked. I mean, the headline narrative is strong. They are promising profitable growth, a new platform launch, and inevitably a pivot into AI data center power.
Because everyone needs an AI pivot right now.
Right, but the reaction on the tape was brutal.
So here is the conflict we are going to break down for you over this deep dive. Management is sounding the all-clear signal. They are super enthusiastic.
But the tape is telling a completely different story. We saw a classic sell the news reaction.
So here is our roadmap for today. We are going to dissect the headline beat, which was actually decent.
Surprisingly decent.
Then we're going to perform an autopsy on the ugly JAP numbers that likely spook the algos. We need to talk about the guidance air pocket that terrified investors regarding Q1.
That's the real meat of the drop.
Exactly. Then we'll get into the Nexis product rollout, and finally we're going to do a serious reality check on their AI data center ambitions.
And we absolutely have to talk about that trade at the end.
Let's stick around for This is not financial advice segment. We have a trade idea we're calling the 2028 leapfrog spread.
It is wild.
It is risky, but the logic is fascinating. But first, let's look at the scoreboard. What actually happened on the tape?
It was not pretty. SolarEdge dropped approximately 5.5% to close right around $35.10.
Now, the price action is one thing. Stocks go up and down.
But as we always say on this show, volume tells the truth. Volume was incredibly heavy. We saw over 10 million shares traded.
For the listener who doesn't stare at level 2 data all day, put that 10 million in context. Is that just a busy Tuesday?
No, this is algorithmic warfare. A normal day for SEDG is roughly 2.8 million shares. So we are looking at about 3.6 times the normal daily average turnover.
Wow.
Yeah, when you see price drop on low volume, it is just disinterest or lack of buyers. When you see price drop on massive volume, it is a battle.
It means institutions were highly active.
Exactly. It's a transfer of ownership.
Yeah.
It tells me that large holders were liquidating positions and someone else, maybe value hunters or short covering, was stepping in to absorb it.
But the selling pressure was clearly dominant.
Very dominant. And the options market was screaming too.
What were you seeing there?
Very hot. Call volume was 25% above normal.
Which is counterintuitive on a down day.
Right, that suggests a real tug of war. You have bulls positioning for a turnaround, betting that this dip is the definitive bottom, clashing directly with the reality of the price dropping.
It is a messy chart right now. Okay, so the market hated it, but let's look at the actual print. Because if you just read the financial headlines, you might be scratching your head wondering why the stock is down. They beat on revenue.
They did. Q4 revenue came in at $335.4 million.
And the street was at what?
The consensus on the street was sitting at roughly $330 million. So a $5 million beat. Nothing earth-shattering, but a beat is a beat.
And the year-over-year number is the one that really jumps out at me.
Massive. It is a 70.9% jump year over year.
Now we have to temper that excitement a bit, right? Because Q4 the previous year was essentially the absolute bottom of the barrel.
Yeah, that was peak inventory crisis. But it shows that the clearing process, that really painful process of 2025, is actually working. Revenue is flowing again.
What about the bottom line? EPS.
Non-GAAP loss per share was negative 14 cents. The consensus was expecting a loss of 19 cents.
So they beat by a nickel.
Right. Again, they are still losing money on an earnings per share basis, but they are losing less money than Wall Street expected.
Okay, so we have a revenue beat and an EPS beat. Let's talk about margins. Because in hardware, margin is everything.
This was arguably the star of the show, and maybe the one thing the bulls can really hang their hats on today.
Yeah.
GAAP gross margin hit 22.2%. That's up from 21.2% prior.
And the non-GAAP.
Non-GAAP hit 23.3%. That actually exceeded their own internal guidance range.
That is significant. That makes 5 consecutive quarters of margin expansion. That is a trend, not a fluke.
Correct. And when you are in a turnaround, that is the exact metric you watch. Can they command pricing power? Can they control their variable costs?
A 23.3% margin suggests that the bleeding has stopped, and they are starting to regain some operational health.
So we have a revenue beat, an EPS beat, and a margin beat.
Which begs the question, why is the stock down 5.5%? What spooked the room?
It's the scary number. If you just glanced at the press release without reading the footnotes, you saw a GAAP net loss of $132.1 million.
Which translates to negative $2.21 per share. That is a massive, scary number.
Huge.
If I am a retail investor and I just see loss of $132 million on my newsfeed, I am hitting the sell button. What is actually going on there?
You have to put on your forensic accountant hat for this one. This is a classic case of kitchen snooping.
Explain that for the listener.
When a new management team wants to turn a corner, they take all the bad news, all the skeletons in the closet, and they shove them into one quarter to get it over with.
Clear the decks.
Exactly. That $132 million loss isn't cash leaving the bank account. A huge chunk of it, $70.5 million to be exact, is something called CTA reclassification.
CTA, currency translation adjustment.
Yeah.
That sounds like the most boring thing on earth. But you were saying it hit the stock price.
It spooked the algorithms for sure. Here is the simple version. SolarEdge owned a battery company in Korea called Kokam. They bought it years ago. Over the years, the Korean won moved against the dollar.
As currencies do.
Right. On the balance sheet, those currency changes are just paper gains or losses. They sit in a dark corner of equity called accumulated other comprehensive income. They aren't real yet.
Until you shut it down.
Precisely. SolarEdge decided to shut down Kokam as part of their broader cost-cutting measures. The moment you liquidate that foreign entity, all those years of currency fluctuations, which were just theoretical paper numbers, suddenly have to be realized on the P&L.
So it is like carrying around a suitcase of foreign currency from a vacation 10 years ago. It doesn't matter what the exchange rate is while it sits in your closet. It only matters the day you finally walk into the bank to exchange it.
That is a perfect analogy. And because they finally walked into the bank, they took a $70 million hit. But, and this is critical, it is a non-cash expense.
Yeah.
It is pure accounting cleanup. It doesn't affect their ability to pay rent or buy parts.
So if I am analyzing this company, do I care about that $70 million loss?
You care about it in the sense that it shows the cost of their past bad acquisitions, but you shouldn't care about it for the future valuation of the business. It is a one-off. It is noise.
But in this market, noise can drive price. Let's talk about something that isn't noise. Cash. Cash is oxygen.
Right.
How is their liquidity looking?
This is the actual good news. Free cash flow was positive, $43.3 million.
For the quarter.
For the quarter. And if you look at the full year of 2025, they generated $77 million in free cash flow. Compare that to 2024, where they burned through negative $421 million.
That is a massive swing, from burning nearly $500 million to generating positive cash.
It is the definition of stabilization. Their liquidity is strong. They have net cash and investments of $244.2 million.
So the bankruptcy narrative, that fear that was haunting them throughout 2024.
That should be entirely off the table. The business is no longer bleeding out.
So financials are stable, cash is positive, margins are up. But the stock still dropped. This brings us to the forward-looking part of the call, the strategic pivot.
The CEO, Shuki Nir, had a very specific message. He said 2025 was defense. 2026 is offense.
What does that mean in actual practice?
It means they are done shrinking. For the last 18 months, SolarEdge has been in full retreat. They've been cutting costs, firing people, closing factories. Shuki detailed the operational cleanup on the call.
They sold off some assets, right?
Yeah, they sold the e-mobility business for $12 million. They sold the tracker business. And they shut down that battery manufacturing in Korea we just mentioned.
They're slimming down to fight weight.
Exactly. They stripped the company down to its core, solar inverters and optimizers. Now, the promise is that this leaner, meaner SolarEdge is ready to grow again. The goal for 2026 is profitable growth and recapturing market share.
And they made a really bold claim about profitability.
They did. Management claimed that if current trends continue, and that is a very big if, they will hit EBIT profitability later in 2026.
Later in 2026. It is a little vague, isn't it?
It is. And that is exactly where the market skepticism creeps in. To hit EBIT profitability, you cannot just cut costs anymore. They've already cut to the bone. You have to scale revenue. You need operating leverage.
And that brings us to the real reason the stock dropped today. The guidance air pocket.
Let's dive into this, because this Q1 guidance was, well, it wasn't what the bulls wanted. It feels like the air went out of the room.
Not at all. Look, everyone was hoping for a linear recovery. Q4 was $335 million. You would hope Q1 would be $350 million right, up and to the right.
Instead, they guided Q1 revenue to a range of $290 million to $320 million.
That's a sequential step down.
A significant one. The midpoint is $305 million. That is a $30 million drop from Q4.
Now, management tried to spin this pretty hard. They said, hey, usually Q1 is down 10 to 15% seasonally. So this is actually better than seasonal.
Which is technically true. Solar is a heavily seasonal business. Winter is slower. Less installation happens when there's snow on the roof in Germany or the Northeast U.S.
But when you are trying to be a growth stock again, investors do not want to hear about seasonality. They want to see momentum.
Exactly. A step down suggests that demand is still choppy. It suggests that the recovery isn't a straight line. It is lumpy and heavily reliant on project timing.
And it wasn't just revenue. The margin guidance for Q1 also took a hit?
Right. They just delivered 23.3% non-GAAP gross margin in Q4. For Q1, they are guiding 20 to 24%.
So the midpoint there is 22%, revenue's going down, and margins are ticking down slightly. Why are margins dipping? If they are so efficient now, why can't they hold the margin?
It is mostly volume. This is basic manufacturing economics. You have fixed costs, your factory lights, your rent, your salaried staff. When you manufacture fewer units because revenue is lower, you have less fixed cost absorption.
Your factories are basically less efficient per unit.
Precisely. They did mention that this is partially offset by a better mix of U.S.-made products, which have better margins due to the tax credits, but the net effect is still a slight step back.
And meanwhile, OpEx is creeping up.
Yeah. Operating expenses are guided to $88 million to $93 million. That is creeping up slightly from Q4. The culprit there is the Israeli shekel.
Explain that relationship for the listener.
SolarEdge is an Israeli company. They have a massive R&D center in Israel. Those engineers get paid in shekels. But the company reports earnings to Wall Street in dollars.
So it's a Forex issue.
Yes. As the shekel strengthens against the dollar, their labor costs, when converted to dollars for the quarterly report, go up. It is a currency headwind they cannot really control, but it eats into the bottom line.
So you put that all together. Revenue down, margins down, costs up. That is the air pocket. Investors looked at that Q1 guide and said, I am not waiting around for 3 months for this to figure itself out.
Precisely. The market is impatient. They see a soft quarter ahead, and they sell. They will wait to buy back in when the growth actually shows up on the tape.
But management is saying wait, a growth is coming. And the vehicle for that growth is this new product launch, the Nexis platform. This is the big catalyst. March 19th, they are holding a launch event in Germany. This is their next generation inverter and battery system.
The CEO, Shuki, he was really hyping this up on the call. He explicitly mentioned that he installed the full Nexis system at his own house just yesterday.
Classic CEO move. I'm not just the president, I'm also a client.
It is marketing fluff, sure, but it shows confidence. If it didn't work, he wouldn't have it on his wall. But beyond the anecdote, there is something buried in the technical docs called single SKU.
It sounds so boring.
It does. Why does single SKU matter?
It sounds boring, but this is actually the holy grail of global hardware manufacturing. Think about the old way. You have a grid in Germany that runs at 230 volts. You have a grid in the U.S. at 240 split phase. You have totally different regulations in Japan.
So in the past, SolarEdge had to build, box, and ship specific inverters for specific countries.
Exactly. So if demand suddenly drops in Germany but spikes in California, you are stuck with a warehouse full of German inverters you cannot legally sell in the U.S.
That is inventory bloat. It traps your capital. It kills your cash flow. Single SKU means they build one box. It is entirely software defined. You ship the exact same box to Munich, to San Francisco, to Tokyo.
And the installer just configures it on site.
Yes. The installer hangs it on the wall, opens the app and says, I am in Germany, and the inverter configures its voltage and frequency to match local codes.
That creates massive optionality.
It creates margin. It means your factory never has to stop to retool for a different region. It means your distributors do not have to guess which model to stock. It streamlines the entire supply chain.
So this is really a margin story disguised as a product story.
If they pull this off, that 23% gross margin we saw could actually go higher, even without raising prices to the consumer.
Okay, that makes total sense.
Yeah.
But there's another technical claim they made about Nexis that I want to challenge. Low load efficiency. They claim it is 99% efficient even when you are barely using power. Why is that a selling point?
Because of how people actually live in their homes. Think about your house at 3 a.m. What is running?
The fridge. Maybe the Wi-Fi router. A phantom load from the TV. Not much.
Right. Maybe 300 or 400 watts total. Most solar inverters are like muscle cars. They are great at 60 miles an hour. But if you try to drive them at 5 miles an hour, they stall or they burn a ton of gas just keeping the massive engine running.
So a typical inverter might be only 80% efficient at those low loads.
Yes. You are burning your expensive stored battery power just to run the brain of the inverter system. If Nexis solves this, if they can stay 99% efficient at 300 watts, that means your battery lasts all the way through the night.
That is a tangible difference a homeowner will notice on their utility bill.
Now, tied to this Nexis rollout is a major shift in their battery technology, moving from NMC to LFP.
Nickel manganese cobalt to lithium iron phosphate.
This is a pure cost play. NMC is very energy dense, but it is expensive and has some thermal runaway risks. LFP is cheaper, it's safer, and it lasts longer in terms of cycle life.
It seems like the entire EV and solar industry is moving to LFP.
SolarEdge making the switch means they can lower their bill of materials costs significantly. This is necessary just to compete with the Chinese manufacturers who have driven global battery prices into the floor.
So Nexis is the near-term hope. But let's talk about the shiny object. The thing that everyone was whispering about before the call, the AI data center option.
The inevitable pivot. It seems every single company needs an AI slide in their deck these days to keep Wall Street happy.
SolarEdge is aggressively messaging their entry into AI data center power. The pitch is simple. Power is the limiting factor for AI expansion. NVIDIA and others are moving to 800-volt DC architecture for the 2027 GPUs.
And SolarEdge is basically saying, hey, we know DC power better than anyone in the world.
And technically they have a point. But we need to understand the physics to see why this is a big deal for data centers. The utility grid operates on AC power, alternating current. But server chips operate on DC power, direct current.
And every single time you convert from AC to DC, you lose energy. It turns into heat.
And in a data center, heat is the absolute enemy.
Exactly. You pay for the electricity, then you pay again for the HVAC cooling to get rid of the heat you created by converting the electricity. It is a double penalty. Currently, the power comes in from the utility at huge voltage, 34,500 volts.
Then it goes through a big transformer out back to step down to 480 volts.
Then it goes into the building, then it gets converted to DC, then it gets stepped down again at the server rack.
It is a Rube Goldberg machine of electricity.
It is incredibly inefficient. SolarEdge is developing a solid-state transformer, or SST. They claim they can take that 34.5 kilovolts, the medium voltage, directly from the street and convert it directly to 800-volt DC.
In one step. No intermediate grid transformers.
That is the magic they are pitching. Normally, you have multiple stages. Each stage takes up massive floor space and loses efficiency. SolarEdge claims their SST can do this in one step with greater than 99% efficiency.
That sounds incredible. Higher power density, smaller footprint, fewer thermal losses. If power is the bottleneck for AI, this solves a huge problem.
The technology is deeply compelling, but, and here is the giant reality check, we need to look at the timeline.
Time to pour the cold water.
The analysts on the call, specifically Brian Lee and Dylan Nassano, they pushed really hard on this. They asked point blank, when do we see revenue? And management was honest, to their credit.
What did they say?
No revenue expected in 2026, no revenue expected in 2027.
Ouch.
They expect the ramp to start in 2028. Currently, they're just in technical discussions under NDA.
So this is a 2028 story.
It is, and that is why the tape treated it as a non-event today. You cannot value a stock based on a product that might generate revenue 3 years from now, especially when the core solar business is facing a Q1 air pocket.
There was also a bit of a technical debate on the call about the materials they are using for this, right? Silicon carbide versus gallium nitride.
Right. Analysts asked about Civex versus Gannon. Management admitted GaN is likely less relevant for this specific high-voltage application. They are betting on silicon carbide.
Which shows they are deep in the weeds on the engineering.
It does, but again, it highlights that this is purely R&D right now. It is not a commercial product sitting on a shelf.
So is this a real business line? Or is this just a desperate attempt to get an AI multiple on a distressed solar stock?
I think the engineering is real, but it requires significant CapEx spend now for revenue much later. That is a very hard sell for investors who just watch the company burn cash for a year. They want to see the core solar business fixed first. The AI stuff is just a lottery ticket for 2028.
Okay, let's zoom out and look at the investor context regarding the regional and regulatory landscape, because you cannot talk about solar without talking about government policy. Let's look at the U.S. market first.
The U.S. residential market is shifting rapidly. We talked about interest rates earlier. High interest rates essentially killed the cash loan market for solar. So now everyone is shifting to TPO.
Third-party ownership. Leasing.
Right. Companies like Sunrun or Sonova, they own the system on your roof, and you just pay them for the power it generates.
SolarEdge claims this shift actually helps them.
It does. SolarEdge has very strong historical relationships with these TPOs. The TPOs care about long-term hardware reliability and fleet management software, which SolarEdge is very good at. Plus, the 48E tax credits heavily favor this leasing model.
And then there is the commercial sector, the C&I space.
This is a bright spot for them. SolarEdge claims they are the #1 market share leader in US C&I, and they have a massive moat here, domestic content.
Explain that for the listeners. Why is domestic content a moat?
The Inflation Reduction Act gives bonus tax credits if you use American-made equipment. If a commercial developer uses SolarEdge inverters made in their Texas facility, they get a 10% bonus on their investment tax credit.
That is huge for project economics.
It makes or breaks the deal. SolarEdge has moved 90% of their manufacturing capacity to the U.S. Their products are domestic content compliant and FIO compliant.
FIO meaning foreign entity of interest, so no Chinese influence in the supply chain.
Exactly. That is crucial. If you are a developer, you need those tax credits to make the project pencil out. You almost have to buy SolarEdge to get the full credit package.
The CFO explicitly said the 45X manufacturing credits are the single most attractive incentive in the world. They're heavily capitalizing on that. It is a regulatory moat built around their U.S. operations.
What about Europe?
Europe is, well, sluggish was the exact word management used. The inventory clearing is mostly done, which took all of 2025, but end market demand hasn't snapped back yet.
They're actually exporting U.S.-made products to Europe now just to utilize that U.S. factory capacity.
It is a bit of a waiting game in Europe. So the U.S. is a policy play, Europe is a slow recovery play, and AI is a future tech play.
That is the perfect summary of the business right now.
Okay, we have covered the numbers, the strategy, the product, and the macro environment. Now it is time for the part of the show where we get a little creative.
The compliance lawyers are sweating right now.
Let them sweat. Everyone, please listen carefully. This is not financial advice. We are two voices on a deep dive analysis. We are not your financial advisors. Do not trade on this. This is for entertainment and educational purposes only.
Standard disclaimers apply.
We are going to pitch an outrageous but plausible trade idea, just like a hedge fund analyst pitching to an investment committee.
All right, set it up for us. What is the trade?
I call this the data center power disconnect, or for the options traders out there, the 2028 leapfrog spread.
I like the name. What is the thesis?
Here is the logic. The market hates the SolarEdge Q1 guide down. The stock dropped 5.5% today, but that is short-term thinking. That is the market obsessing over Q1 residential inventory in Germany.
Which is valid for this quarter.
Sure. But the single biggest macro bottleneck for the next decade is AI power constraints. Data centers need immense amounts of power. The utility grid cannot supply it fast enough.
I agree completely. High voltage transformers are on a 2-year back order globally. You cannot build data centers fast enough simply because you cannot get the power gear. Exactly.
The legacy grid relies on these massive oil-filled transformers. They're literal dinosaurs. SolarEdge just confirmed on the record that they have a 99% efficient 34.5 kilovolt to DC solution that bypasses those traditional grid transformers entirely.
The solid-state transformer we talked about.
Yes, so the trade is this. You go long SolarEdge LPS, long-term equity anticipation securities. You buy the deep out-of-the-money January 2027 or 2028 calls. You are buying the time for the tech to work.
You are buying a lottery ticket on the 2028 data center ramp.
I am betting that by 2027, SolarEdge isn't valued as a cyclical solar company with a 15x PE ratio. I'm betting it gets re-rated and valued as a data center infrastructure company with a 50x PE multiple.
And you are buying that multiple expansion for essentially free because right now everyone is only focused on the Q1 residential solar weakness?
That is exactly the play.
That is a highly aggressive bet, but you need a hedge. If the solar business keeps tanking, those APS go to zero before 2028 even arrives.
That is the twist. You pair it by shorting a legacy transformer utility ETF, or you short a specific legacy hardware provider. Pick your favorite dinosaur that relies heavily on those inefficient AC to DC conversion steps.
So you are long the disruption, the SST, and short the bottleneck, the legacy transformers.
Exactly. It is a leapfrog spread. You fundamentally believe the new tech will leapfrog the physical grid constraints.
What is the risk profile here?
The risk is NVIDIA changes the spec from 800-volt DC to something else. Or the SST technology blows up during the beta testing phase. Or frankly, SolarEdge runs out of cash before 2028.
Or the grid utilities just simply refuse to certify the new tech because utilities are famously slow to adopt anything new.
Always a risk. But if it hits, you bought an AI infrastructure play at distressed solar prices.
It is outrageous, but it is entirely plausible.
That is why we do the show.
Oh.
Okay, let's wrap this up and distill the key takeaways for you.
Q4 was a solid beat on the top and bottom lines, but the Q1 guide was undeniably soft. The turnaround is happening, but it is nonlinear. It is bumpy.
The cash flow is positive, which is the most important fundamental floor for the stock.
And the AI story is a fascinating, albeit distant, lottery ticket.
The company is screaming offense, but the market is still playing defense. My final provocative thought for you to mull over: watch the March 19th Nexis launch event in Germany.
Don't just watch the stock price that day.
Exactly. Watch the actual product reviews from the installers. If the product is real, if it delivers on that low load efficiency, and the installers love the single SCO use setup, the narrative might shift much faster than the algorithms expect. Pay attention to the engineers, not just the tape.
And keep a very close eye on those margins. If they can hold that 23% gross margin while revenue dips in Q1, that proves the operational excellence story is actually real.
Talk Tickers signing off. Check the numbers, trust the tape. We will see you next quarter for the Q1 deep dive.
Goodbye, everyone.